This is your LMAX exchange technical update for Friday, May 12th, 2017. Euro dollar. So the euro's in a bit of a tough spot right now. Overall, the market has broken out in recent weeks, and this breakout to fresh 2017 highs projects a move up towards 114 over the medium term. If you look back, you can see the market's been basing out over the past several months since putting in that low, that multi-year low in January of 2017 at 103.41. We've been making a series of higher lows and higher highs, and we've also seen the formation of an inverse head and shoulders that, again, projects gains up towards 114. At the same time, we've seen the onset of a correction at this point, and it's only a correction where the market should be looking for a higher low ahead of a continuation of gains. But this correction could still extend lower down towards the 107.30 area, which would be filling that gap that we saw post-French election, the first round of the French election. We saw that gap on the Monday open between around 107.30 where we closed on Friday up towards that Monday open above 109, so 200 points of a gap that was somewhat filled, but again there's still a gap roughly between 107.30 and 108.20 that needs to be filled, and so that's a possibility. Naturally, again, as the market moves higher, it makes higher lows and higher highs, and so already we could see this pullback extend even without the gap down towards the 107 area. So I think that should be considered, the possibility that the setbacks extend down towards 107.30, at which point the market then should ideally in that area around 107 be looking to put in a higher low ahead of that continuation of gains. Only back below the previous higher low, which comes in around 105.70, would compromise the constructive outlook for the euro. Sterling dollar. So cable has been in the process of consolidating above the previous range high from December of 2016 at 127.75. That was a range that was capping the market off that yearly low, that multi-year low, that plus 30-year low that we'd seen in October of 2016. Since October of 2016, the market was range trading with, again, that high of the range at 127.75 from December of 2016. And that went on until we finally broke out back on the 18th of April. The breakout then is a significant breakout as it ends that base. It suggests that this market could also be bottoming out, and there's fresh upside now projected towards 135. The projection comes from a consolidation that was roughly 700 points between roughly 120 and 127. We did trade down to extremes of 118.40 and the range resistance at 127.75, but if you consider most of the price action was confined to 120 to 127, that seven big figure consolidation on the breakout projects from 127, seven big figures higher, to 135. So that's where we could be headed over the medium term. At the same time, just like the euro, the market could be very open to the possibility of a bit of a corrective pullback before we see any meaningful highs up towards 135. So again, we could push up above 130, but there is risk that we see a healthy correction, maybe even back towards the 125 area before the market puts in a higher low and heads up towards that 135 objective. At this point here, only back below 23.60, a low that we saw back in early April, would compromise the constructive outlook for sterling dollar. Dollar yen. So dollar yen has done a good job of breaking out over the past several days off those, since recovering from the 2017 low just ahead of 108, and the breakout back above some resistance that had been in play at 112.20 and some falling trend line resistance off of some highs that we had seen back in early January. The break above both of those levels does take the immediate pressure off the downside. At the same time, the market is still trading below 115.60, which is, if you can remember, a range high that had been defining the price action, the top of the range going back to earlier this year. And so while the market holds below 115.60, it still could roll over. So we're kind of in a neutral territory here where the market, despite taking the pressure off the downside, is not neither here nor there, and we could just as easily stall out and trade back down. If we break down below 112 again, that will do a good job of putting the pressure back on the downside. If, however, we are unable to break below 112 and we push back above 115.60, that will force a shift in the structure. So right now, dollar yen kind of in the middle of nowhere. We've taken the pressure off the downside following the breakout above some 12.20 resistance and trend line, falling trend line resistance off that early 2017 high. But at the same time, we're still trading below 115.60. So kind of a wait and see with dollar yen. 112 and 115.60 are the key levels to watch above and below. Euro Swiss. So Euro Swiss has been making some notable moves over the past several days. This is a market that really hasn't been doing much, but is an important market to watch. And the breakout to the top side does suggest that maybe this market is wanting to make a more significant move, a structural shift that would open the door for significant gains ahead. But we're coming into some key psychological resistance, which is also resistance going back to highs that we had seen in August of 2016 at 110. And so the market would need to establish above that psychological barrier to convince of a potential structural shift. Until then, there is still risk that the market stalls out here and trades back down towards lows towards 106. There's been a lot of very strong support around 106, and the market would need to break down below there to convince of a bearish continuation. So it's a bit of a wide range right now, but we're up towards 110, which is going to be important to watch, and then 106 to the downside is the important area to watch for Euro Swiss. Aussie dollar. So Aussie has clearly been under pressure over the past several weeks since posting that 2017 high that we saw back in March. The market has broken down, trading down below psychological barriers at 75 and looking like it could be poised to continue this downside extension towards key support, which now comes in at 71.60, lows that we saw back in December of 2016. At the same time, that wouldn't rule out the possibility of a bit of a correction here. So we could see the market head a little bit higher, but now look for rallies to be well capped into previous support turn resistance around 75. You can see 74.75 was that previous support now turn resistance in favor of a lower top and continuation of declines. Only back above 76.11 with this market would compromise the bearish outlook for Aussie dollar. Dollar CAD. So dollar CAD has been trading within an intense uptrend, breaking to fresh 2017 highs and now closing in on next key psychological barriers at 140 further up. For now, the market is stalled out just ahead of 138 at 137.94, which is the 2017 high that we saw just a few days back on the 5th of May. And so the market continues to be quite constructive, but there still is risk given the intensity of this latest run that we saw that started back in earlier in April, that we could see a bit of a corrective pullback. If we do see setbacks, these setbacks should now expected to be well supported in the 134 to 135 area, with only a break now back below that low that we'd seen around 132.20 from the 13th of April to compromise or take it to sort of at least delay the constructive outlook. But until then, setbacks are viewed as corrective with another higher low seen in favor of a fresh push towards psychological barriers at 140. Kiwi dollar. So the New Zealand dollar has been showing signs of topping out over the past several months. The market put in a 2016 high just shy of 75, which you can't see here. But then in 2017, it stalled out ahead of 74. And since then, it's kind of been breaking down, putting in lower highs and lower lows. Most recently, we saw a fresh lower low confirmed at a fresh breakdown below the 2017 low at 68.39, confirming a fresh lower top at 70.90, and that breakdown that we saw below 68.39 would now project roughly a move that could take us down towards the next key psychological barrier here at 65. Any rallies that we see here should be very well capped, and it is possible that the market chops around a little bit, but the market should ideally hold below 70.90 to keep that bearish outlook intact and exposing additional setbacks towards that next key target to the downside in the 65 area. SPX 500. So although we've seen a bit of a pullback in the S&P 500 since it broke most recently to a fresh record high on the 8th of May above the previous one that was set early in March and rallying up to just about 2406. We had a previous high at 2400, about just maybe a little bit over, but basically matching and slightly exceeding that high. We've seen some setbacks since then, but although we've seen those setbacks, the setbacks are nothing more than minor, teeny tiny correction, and the pressure at this point clearly still remains on the top side, with the market potentially now eventually heading up towards the next key target at 2480. If you look at the consolidation that we had seen or the period of correction that we had seen from the previous high in early March at 2400 down to critical support now at 2320, that was an 80-point move. And so the break to fresh record highs back on the 8th of May suggests an 80-point measured move to the top side at 2480. So that is still a possibility. Of course, this is a market that's continued higher and higher over the past several years and is a trend that's been quite intense, which many are looking for a top, but there's no reason to be calling for that top until there's some form of confirmation. At a minimum, that confirmation is going to be required on a breakdown below 2320, which is the major level of support to be watching in the S&P 500. So 2380 really is that next potential target right now. Interestingly, and perhaps we'll go over this in another special report on the S&P 500, that 2380 area coincides with a confluence of significant support levels. If you look back at moves that we had seen in this market from the 2007 high to the 2009 low, and the projections off of moves from that period, and then from 2015 to 2016 breakout projections all come up into the 2400s, or between 2450 and 2500. So a lot of confluence of resistance up there on a longer term basis too, which makes things interesting around current levels. But again, we'll look to get into that maybe in a special report. But right now, it's important to note that while we hold above 2320, this market continues to be inclined to want to push higher, and 2480 is that next key target. On a very short-term basis, you want to pay attention to support around 2378. If that's broken, then on a short-term basis, it takes the short-term pressure off the top side. Gold. So gold has, despite the latest round of intense setbacks that we've seen, if you pull back the chart a little bit here and you look at this, since 2016, the market has been recovering after stalling ahead of 1100, making a series of higher lows and higher highs. And so there's no reason at this point to expect that this won't continue with the market pulling back, but ideally looking to put in now a higher low above the previous higher low at 1195 and heading back towards and through the recent fresh 2017 highs that we had seen on the 17th of April at 1295 and up towards what is that next measured move that we've projected around 1335, which is just shy of the 2016 peak at 1375. So again, for now, there's every reason to sort of be still thinking the gold might put in a higher low here in favor of additional upside. Clearly, we would have to break back above 1295 to a fresh 2017 high to continue this trend. And at the same time, if the market breaks down back below 1195, that previous higher low, that will compromise what could be a constructive outlook for gold. But again, the key takeaway right now is despite these pullbacks, we're still seeing an overall constructive trend of higher lows and higher highs. And so the market could be once again looking to put in a higher low. That will be confirmed on a break all the way back above 1295. But on a short-term basis, if the market can get back above the 1240 area, it will really encourage this prospect.